Let's see how the stock market drives, wealth creation and economic stability. How does the stock market promote wealth creation as well as economic stability? And the stock market plays a crucial role, in wealth creation and maintaining economic stability by facilitating capital allocation, providing investment opportunities, as well as contributing to a general economic growth. So you discover that this particular topic, could be discussed under a number of subheadings. So I want to consider number one, wealth creation. Wealth creation. And when it comes to wealth creation, we are talking about capital appreciation, dividends, as well as some ownership of companies. Let us, consider capital appreciation. By investing in stocks, investors can experience capital appreciation, as the value of their shares increase over time. So this growth in stock prices help investors build wealth, particularly for those who hold long-term investments. Dividends. So stocks that pay, dividends regularly provide a steady income stream for investors, further contributing to wealth creation. These dividends are often reinvested. By so doing, it tends to compound over time. And we want to look at ownership of companies. Through stock ownership, investors gain a share of the profits of companies they are invested in, which can result in both capital gains as well as some dividends, contributing to individual wealth. So the stock market essentially is a huge avenue of wealth creation. You don't need to own and operate a business at an individual level. You just simply invest in good businesses in the market, and you get to enjoy capital appreciation as well as dividends income. So personally, I like the stock market because I was once, should I say, a businessman or whatever. I had a business many years back. I had a cyber cafe that eventually went under. When my ISP, that's Internet Service Provider, raised, almost like they raised the subscription fees, so I couldn't cope. My subscription was raised from 48,000 naira to about 90-something thousand naira, and the business crumbled. So from then, me and business, bye-bye. I prefer investing in the market. Better, well-run, profitable business with fortress balance sheets, strong fundamentals, and I just create wealth with no stress. Number two is facilitating capital allocation. Facilitating capital allocation. So in this case, we consider raising capital, for companies as well as efficient resource allocation. So let's look at raising capital for companies. The stock market allows companies to raise funds, very cheap funds at zero interest, by issuing shares to the public compared to going to borrow money from the bank. You borrow this money from the public, so to say, at 0% interest rate. This capital can be used for expansion, for research, for development, and other projects that stimulate economic activities and create jobs. Let's look at efficient resource allocation. The stock market helps allocate capital to the most productive businesses. Exactly, it's like the entire market is competitive. Better run companies tend to attract funds, and loss-making companies, will not be able to attract the same level of funding. And so investors analyze and invest in companies based on their potentials for growth, driving funds to industries and sectors with the best prospect for success. So in this case, investors are doing very well. At least they are logical in their thinking. They're not sentimental. Number three is promoting economic growth. Promoting economic growth. So in this aspect, we're looking at investments in innovation and expansion, as well as some consumer confidence. Let's see investment in innovation and expansion. So as companies raise capital through stock market investments, they are able to innovate, not only innovating, but they equally, expand their operations, gaining market shares, and improve their products and services, which contributes to economic growth and job creation. So it also, boosts consumer confidence. Rising stock prices improve, consumer confidence as individuals, feel wealthier and, and more financially secure, often leading to increased consumer spending and, further economic growth. As some people are becoming wealthy, there's this particular concept of FOMO, fear of missing out. Other people are actually coming to the market to see how they can equally make it. So all things being equal, and they tend to, create wealth also. But when the market goes goes south, you discover that the party may be over. So you take all these things into consideration. Number four is before then, please subscribe to this channel, all right, and like this video. Okay. Well, if you are the outspoken type, you can drop a comment in the comment section. All right, but more importantly, subscribe to this channel and like this video. So we consider market liquidity and stability. So in this case, we look at liquidity. The stock market provides liquidity, allowing investors to buy and sell shares quickly and easily. This liquidity fosters confidence, enabling individuals and institutions to adjust their portfolios and investments according to market conditions. I want to share a little personal experience here. There's this small, tiny plot of land I want to sell. And after how many days now, I've not been able to sell it. You understand? But if it is in the market, the same day I key in a sell order, bam, my order is executed. But now you have to look for buyers, and when they come out to haggle with the buyers, haggle with the agents that will demand part of the money and all those things. It's not. I don't like real estate investments. That is not my style. No. I want to sell. I have to advertise. Call this one, call the other one. Please, I have land for sale. Help me. That kind of a thing. And anybody that wants to help you will equally want a piece of the profits. All those things, But in the market, just within the confine of wherever you are, key in your order, either in your computer or in your smartphone. Bam, everything is executed. Up stock market. I'm not against real estate investment, but generally, I prefer the stock markets. You could do everything confidentially. You don't go out to be announcing to this one, to other people, oh, come and buy, I have land for sale. No, everything could be done, confidentially. And personally, I don't like publicity. So that's it. That's by the way. So economic stability. A well-functioning stock market can help stabilize the economy by, serving as an indicator of economic health. Market performance often reflect investor sentiment, guiding policymakers and businesses in making informed decisions. And then lastly, number 5 is retirement savings and wealth distribution. Retirement savings and wealth distribution. So we consider, pension funds and 401ks. The stock market is a key component of retirement savings plus, of entire this they call them the pension fund administrators, right? So it's a kind of, is a key component of retirement savings Retirement saving plans, like the 401ks. In my country, we call them pension fund administrators, you know. So long-term, stock market growth help individuals save for retirement, contributing to financial security in later life. Because these funds are invested in the markets generally. A portion of the capital under management, the fund under management, are are invested in the stock market. So wealth distribution. By enabling a broad segment of population to invest, the stock market helps distribute wealth across different socioeconomic groups, allowing more people to participate in economic growth. People of different different social class, can very easily have access to the stock market. So in conclusion, the stock market fosters wealth creation by providing opportunities for capital appreciation and income through dividends, while also driving economic stability by facilitating capital allocations, investments in innovations, as well as maintaining liquidity. So company coming to risk of recent, the banks in Nigeria, they were directed to recapitalize, and banks like GTB, Zenith, Access, and others came into the market to raise capital, to augment their capital base, and they did that free of charge, zero interest. They got monies through investors. That's it. So the stock market actually drives wealth creation in the economy, and we've just explained this particular concept.